Welcome to AM Best Audio.
Premium generated from U.S. directors and officers' liability coverage declined for a fourth straight year in 2025, reflecting heightened competition in the segment as warning signs loom over commercial lines underwriting performance. That according to a new AM Best report. We're joined today by two of the authors of that report, Associate Director David Blades and Senior Industry Analyst Christopher Graham. And Chris, let's start with the overall volume of direct premiums written. While the segment is still up considerably from 10 years ago, that volume has tapered off. What's behind that development?
There's been a good amount of new entrants over the past 5 years. So that's bringing capacity with price cuts. And then, the results have been actually pretty good. So, as long as insurers are making money, they're going to keep, cutting price until they find an equilibrium. So that's part of it, is just, pricing cuts. Another thing that we've seen is really a big drawback in the number of IPOs. So that cuts down on the transactional coverage that usually goes with directors and officers insurance. That did turn up a little bit in the second half of last year. We'll see what happens through 2026. There was a good start to the number of IPOs, but that kind of stalled with some, as the stock market kind of stalled out. I shouldn't say stalled out, more like kind of leveled off. It's not that we've been seeing a drop, but it's kind of leveled off. So there's been a kind of a slowdown in the IPOs for this year, but we'll see how it pans out over the full year. But that's really what it comes down to. It's a decrease in demand and an increase in capacity or supply. It's economics 101. It's driving the premium down.
The report references some still favorable underwriting margins, but some indicators point towards headwinds for the D&O segment. Can you touch on a few of those?
Sure. So again, like I said, it is still profitable, but one of the biggest headwinds that we saw in 2025 was some adverse development starting to creep in on accident years 23 and 24. Now, we had seen some favorable development on accident year 23 during calendar year 24, but that reversed. So that's one headwind, and that did stall some of the positive results that we saw, in the past. The loss ratio was up. Another headwind that you'll see is social inflation. This is really something that, a lot of long tail lines have to worry about, a lot of casualty lines. And as we see social inflation creep up, D&O would be one segment that's hit. Overall, security class action suits have been relatively stable. So if we see an increase in security class action suits, that's another headwind that the D&O insurers will be facing.
David, Chris mentioned accident years 2023 and 2024. How much of a concern is the adverse reserve development for those years?
Well, I think as we think about and as we analyze the profitability on a calendar year basis of directors and officers liability insurers, I think it's definitely an issue that we have to continue drilling down on and looking at. So it's an important issue. I think one of the challenges is that D&O liability isn't a specific or a particular line of business that's measured, via the annual financial statements that companies file. It doesn't have its own line. So from our standpoint, we get some insights, and we feel you can get accurate insights from looking at the other liability claims made, loss reserve development information in Schedule P of the financial statement. And we think that that's viable because D&O liability probably on a premium basis makes up about 25% of the other liability claims made premium. At least in 2025, it was actually more at its peak, in 20 and 21 where D&O liability premiums were increasing. It was probably more in 36, 37% rate. So looking at the trends of other liability claims made and seeing, as Chris mentioned, that accident years 2023 and 2024 are trending adversely is definitely a flag that we're looking at. And really, it's it's the premiums that have been, steadily going down, and reserves, which are a function of those premiums, not enough reserves being put away. In those 2 years, the initial reserves that were set up have definitely shown to be deficient or proven to be deficient. Prices were still going down, or premiums are still going down in 2025. So again, this is going to be a third year where we're going to look at the end of this year, whether 2025's accident year reserves also trended adversely. So it's definitely worth looking at, and it's something that we'll continue to analyze as we look at the overall health of the directors and officers liability market.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Are there evolving risks that are facing the D&O segment?
And there are definitely evolving risks. We talk about several of them in the report. I'll touch on a few of them. Sort of the confluence or the convergence of cyber liability and directors and officers liability, and kind of what we see from that standpoint. Corporate officers are definitely sort of on the hook for securing the proper cyber coverage and lawsuits that come out of maybe not obtaining adequate coverage from that standpoint. Though we can see lawsuits come from that. They're also on the hook for oversight from the standpoint of cybersecurity. And so again, any inadequacies that possibly lead to lawsuits against the company from corporate officers not doing a good job overseeing and managing cyber, we think that can have a meaningful impact. And so that's something that still evolves as cyber liability and cyber security and cyber risks continue to evolve. Again, we talk in our cyber reports all the time about the bad guys still being far ahead of the good guys. So those types of risks are still definitely potentially falling at the feet of corporate officers. Another evolving issue is just the redomestication of companies out of or redomesticating to states other than Delaware, which is where 60% of the public companies are domiciled. We've been seeing over the last few years a number of companies redomesticating to states like Texas and Nevada, where they feel just the overall rulings that were coming out of the Delaware Court of Chancery, which handles merger disputes and shareholder disputes. Some of the companies feel that those rulings have been adverse from a corporate perspective, and so they're looking for other environments or other states. And Texas and Nevada have been two of them that they've been moving towards. So we'll continue to look at if we see that continue to happen. 2025, Delaware passed some laws, or passed one big law that was designed to address some of the concerns from that perspective. So we'll see how that plays out as we continue going forward. And then, you probably can't have a discussion with anybody talking about insurance and not mention AI, right? Corporate officers are definitely, again, have the responsibility for how AI is being managed in their operations and how it's being disclosed. And so the risks that are involved with potential for lawsuits coming back onto the corporate directors and officers from inadequate management and inadequate monitoring or inaccurate disclosures, those kinds of things that may result in lawsuits or D&O lawsuits. That's another issue that continues to evolve as AI, as it becomes more of an enterprise risk that companies are trying to manage, and as it becomes more ingrained in industries all across, or I should say across all industries. So those are some of the issues that we continue to look at. And like I said, it makes this a very dynamic line of business and a market for us to follow.
Thanks, David. Chris?
Thank you.
Thank you, John.
That was Associate Director David Blades and Senior Industry Analyst Christopher Graham. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.